Okay, welcome everybody to today's webinar. Is your SMSF audit and future proof? Why did I pick such a subject matter? Well, I guess it's timely because we've just moved into 1 July, or sorry, we've just moved past 1 July, so we've moved into the new financial year. But of course, from an audit point of view, we're about to start preparing our fund for the 21-22 year, having just finished the lodgement cycle for the 2020-21 year, and of course, no doubt there are still funds out there needing to be lodged for that period. So the whole concept behind future proofing and audit proofing the fund is not so much about saying, okay, well, let's just make sure every fund can breeze through audit, albeit that would be an ideal environment for everybody, but it's about sort of what steps can we take and what things do we need to be mindful of to ensure the best possible process for a fund from an administrative point of view. So I spent a lot of time talking to our client managers here to get a good appreciation for what they do in the admin space, and also then top that out with the information that I am often providing in the education scene for people. So what I really want to sort of work through today is tying a lot of these issues together with the SMSF reporting obligations. So not so much, whilst it's all linked to the annual return, everything's linked to the annual return for the fund, it's really the various ad hoc elements of reporting that I want to encapsulate in the webinar, but also, I guess, the reporting that's not necessarily reporting for tax office purposes, but also reporting from a trustee point of view, just so that you've got information sitting on file that in the event of questions being raised from the auditor and potentially the ATO in an audit scenario as well, that you've got the supporting documentation there. So there's a number of, I guess, practical reporting obligations attached to superannuation funds that we need to contemplate throughout the year, on top of the fact that our overall obligation is to lodge a return. And of course, critical to everything in that regard is this concept about the timing of transactions, and no more critical will it be in the future, and the future being now, with reference to being able to make contributions right up to age 75, where the things such as the timing of commencing a pension, the timing around making personal deductible contributions and then lodging a notice of intention to claim a deduction, all those sorts of things become pretty critical, because if you get the timing wrong, it could result in, obviously, tax consequences to the fund, but also tax consequences personally, because deductions will be disallowed, and potentially also from a timing point of view, we could end up with excess non-concessional contributions, excess concessional contributions, whatever it might be. So many things become fairly important with reference to when we actually time them. And again, last week is one of those critical times in the year, sort of the build up to 30th of June, to make sure all contributions are received by the fund if we want to get that deduction in for that year, making sure that all pension payments are paid by the 30th of June, not just the transaction sort of is commenced on the 30th of June and then the money comes out the following day. It's a matter of making sure that we meet all of the obligations in the year. So all of these sorts of things tie together to, I guess, build the perfect fund experience for SMSF trustees, for accountants and administrators preparing the fund, and then ultimately from an audit point of view, allowing the fund to breeze through as quickly as possible through the audit process at the end of the year. But I think it's also timely to look back a little bit, because looking back means, or provides us with the requirement to also look forward to the impact of measures that were introduced as part of the COVID release or relief packages that sort of came into effect in the 2019-2020 year. And whilst that seems like such a long time ago, what sort of transpired in the environment since then is that we've had this ongoing relief and almost an expectation year on year for that to continue, but with no real position from the ATO about the 22-23 year. We've got to make the assumption that no further relief measures beyond what we've already seen will occur, but how do funds actually transition out of the COVID relief period, and how do they make sure that some issues such as the deferrals of rent, the deferrals of loan repayments, and how do they actually deal with those issues moving forward. So they're all pretty critical elements, one from an audit point of view, most definitely, but also from a future point of view, ensuring that the fund either has the cash flow to potentially pay off outstanding liabilities, but then if it's also transitioning into pension, that it can also meet its pension obligations. So there's just so many sort of things that we tie together. And when I started to put this presentation together and list my dot points, it provided a fairly significant I guess, image of all the things that we have to contemplate. And I'll bring that image up in a moment. But it sort of made me start to work through and say, how interconnected are all of these things? And the short answer to that is that they're all very interconnected. So, when we're talking about contributions and claiming deductions or making fund expenses or paying fund expenses, receiving fund income, they're all linked to when do we start pensions, when do we do transfer balance account reporting, when does the ECPI deduction kick in, what's eligible for the ECPI deduction. All of these sorts of things are ultimately linked. And so everything from the very first transaction through to the last becomes important to ensure that we can maximise our tax exemptions, we can maximise our benefits, and ultimately we can deliver on the ultimate sole purpose test requirement of providing the best retirement income that we can, based on so many other elements associated with the fund. So it's really a very broad overview session, touching on, I guess, all the key issues as I see it, and understanding and appreciating that there's possibly areas that I haven't even contemplated in today's session, with regards to what we have to do to make sure our fund is largely a compliant fund, but also providing the best possible outcome for us. And a lot of that obviously comes down to the decision making of the trustees and the members, and so we'll work on those issues as we go through as well. So as you can see, what I just mentioned before was this imagery of all of the key issues that I see them from both an audit and a review point of view that we have to contemplate. And I want to work through the key elements of each of these issues through this 1 hour presentation. So whilst I'll touch on elements associated with investment strategies, deductible contributions, insurance, and the like, everything that's listed on the screen, it won't be a deep dive into any of them, because each of these subject matters is a session unto itself. And so in many respects, this is also forming the catalyst of my next 12 months of presentations and beyond, because we're always needing to work out where we're sitting with regards to all of these issues. And, from a personal point of view, the whole idea behind the future proofing concept is, after this week, I'm going on annual leave for 3 weeks. I haven't done it for a while, but you have to sort of take stock of your own life and work out, have I got everything in place to make sure that my personal life is future proofed? Have I got all my documentation sorted? And without getting morbid or anything like that, have I sorted out my will, my enduring powers of attorney, all those sorts of elements? And they're the same questions whether we're asking them in our personal life or when we're asking them in our self-managed superannuation fund. Have we taken care of all the things that we need to? Because I know, having my own self-managed superannuation fund, that generally, we tell everybody what their obligations are, but the last person to implement those obligations is ourselves. And I suspect for many of you, you're in the same position in that you look after your clients first and then yourselves last with regards to some of your obligations, but we all have to sit back. So all of these things are as equally relevant to your own funds, whether they be self-managed or superannuation for other purposes. So let's jump into it. And what I wanted to start with was just a couple of key issues from the recent, or the updated superannuation rates and thresholds that apply from the 1st of July 2022. Now, really, I only wanted to touch on two of these, but two of these that have an impact on other strategies that might be applicable in the SMSF space. And the first one is the safe harbour LRBA interest rates. So we know for the 22-23 year, or we know each year, the ATO release updated interest rates based on Reserve Banks and Reserve Bank, the lending rates that they provide in May. And so the variable rate for real property is 5.35%. For listed securities, It is 7.35, so we add the additional 2% there. But what we need to understand is if we've got a limited recourse borrowing arrangement in place and it's under the Practical Compliance Guidelines 2016-5, then we need to make sure that we're updating our interest rates if we've applied a variable rate to the 15-year loan term. Alternatively, if we've applied a fixed rate, which we can only fix for 5 years under the guidelines, then where are we at in that 5-year period? If we set that up in the 2017 period, so if we set it up post the implementation of PCG 2016-5, then we're probably at the end of our 5-year cycle, because that was all done in around the 2017 timeframe. We're probably at the end of our 5-year cycle. We now need to move over to the appropriate variable rate in this year. So these are all the sorts of things that we need to be monitoring and keeping on top of with regards to our fund to make sure that, one, we're future-proofing it from an administrative point of view, but most definitely also from an audit point of view, that we're not getting captured at the end of the year by not paying enough from a loan repayment point of view, and then subsequently getting that raised as a query from the audit position, right? Because we just don't want to have to engage in those conversations, any of us, about why hasn't this amount been paid. So now's the time to start looking at it and reflecting that in the interest payments that we make. On a totally unrelated rates and threshold issue is that the super guarantee rate has jumped to 10.5%. And so what that obviously means is that for somebody, regardless of what they're earning, they're going to be receiving higher employer contributions than they received last financial year. Now, what that's going to mean for those that do salary sacrifice is they need to reduce that salary sacrifice amount down if they were already salary sacrificing a fixed amount to take them up to the $27,500 for the year, because we haven't got any indexation on the concessional contribution caps. And, you know, it's feasible. I think it's going to take potentially a couple more years before we get additional indexation on that cap. So we need to just take that into consideration, because we don't want to end up with excess concessional contributions and therefore paying marginal tax on those amounts. If we can help it, we know it's not the be all and end all if we go down that excess path, but it's a nuisance factor. It's the nuisance of having to deal with the regulator and potentially either withdraw those monies from the super fund via the tax system, or have them treated as non-concessional contributions, which then may impact our non-concessional contribution planning. So, you know, now's the time that if we're engaging in, or our clients are engaging in salary sacrifice practices, that they're reviewing those practices to make sure that they're in line with the contribution caps. So just, I guess, a couple of little key proofing items that we need to be mindful of. And of course, a lot of the other rates and thresholds are just our, you know, indexing of the various contribution limits and other things, such as the CGT amount, but also the low rate cap for lump sum withdrawals, which for me is a real interesting one, because we're getting pretty close to that superannuation low rate cap being an irrelevant cap, because we have people over the age of 60 very soon being the earliest possible preservation age. So right now, whilst we've got preservation now at 59, you know, the window of lump sum withdrawals is certainly much smaller. So yeah, just a couple of key issues that I wanted to raise there. So from a reporting point of view, as I said, we've got our annual return that is our key issue that we need to be preparing for and getting ready, and hence we're now preparing funds for audit with the ultimate objective of lodging the return. First year funds need to lodge in February next year. Obviously you've got your late and non-lodgers who would have an October lodgement date that they need to be mindful of this year. But then for the vast majority of us, we're working towards a May or June 2023 lodgement date for the 21-22 year. But besides the annual return, trustees and members have other reporting obligations that they need to be consciously aware of, subject to the various strategies that you might be talking to them about implementing inside their superannuation fund. So from a contribution point of view, you know, are they lodging their contribution splitting forms in a timely manner? And, you know, for me, from 1 July 2022, where does contribution splitting sit in regards to future contribution strategies? With the extension of contribution age out to 75, will that see a lessening of the use of contribution splitting, or will people just continue to use it as a strategy to help build up, from a compounding point of view, a member's balance, through their lifetime, rather than doing recontribution or spouse contributions in that period 65 to 75. So have people lodged, or are people lodging their contribution splitting applications on time? Downsides of contribution elections, small business CGT elections, are all of these being made with the contributions to the super fund? Again, not elections that get made to the tax office, but the members need to provide them to the trustees of the fund to ensure these amounts aren't treated as non-concessional contributions, and also obviously to trigger a review of eligibility for these contributions to make sure they're not treated as non-concessional contributions. But we need to make sure that that information is provided. The request to adjust concessional contributions. So again, it's whilst not the most common of strategies, there is still a lot of value in people utilising the old contribution reserving strategy, for want of a better term, where somebody makes the higher contribution in the June period to get the larger personal tax deduction, and then moves that contribution across to July from a cap consideration point of view. And of course, the key issue there being that once you've made the contribution, it's reported in the year that it's received, but you then have to lodge that request to adjust the concessional contribution with the ATO. So this one is a requirement to the ATO to ensure that that amount doesn't count towards your cap in year one. So again, a very important document to do as early as you can, to avoid the issue of diving into the excess concessional contribution area. And linked to all of that is the notice of intention to claim a tax deduction. And so, when I arrow across and move across to the income stream requirements, the notice of intention to claim a deduction, and we'll talk about personal deductible contributions through the presentation as well. But the timing of that, whilst you've got effectively up until the end of the next financial year, or the day that you lodge your personal tax return, you may actually have an obligation to lodge that notice a lot earlier. So, if, for example, you are starting a pension in the year, or if, for example, there's this crossover now where our benefits become unrestricted non-preserved at 65, but we're making a personal deductible contribution between 65 and 67, then we're in a situation where, if you're going to take the lump sum will assume that your benefits are all non-concessional, unless you've lodged a notice of intention to claim a deduction prior to that lump sum being withdrawn. So all of those sorts of things are implicitly linked to each other. And again, same with that whole pension commencement point of view. Well, if you want to do the contribution splitting, then you're going to have to lodge your notice of intention prior to the contribution splitting application, prior to the pension commencement. So, this cycle of timing becomes exceptionally important. And then also having all of this documentation lining up from an audit point of view, to be able to see the natural flow of transactions occurring. So it really is going through that thought process of making sure that that members and trustees, albeit the same people, are acutely aware of what their obligations are if they're trying to entertain any pretty much non-standard, but in many instances standard transaction inside their self-managed superannuation fund. And of course, as I've alluded to a couple of times, this period 65 to 75 being the new, contribution strategy period of opportunity, where the removal of the work test from 1 July 2022 from the super conditions means that we're going to have a lot more people, or I consider that we'll have a lot more people that will be running pension and accumulation funds alongside each other, where there will be greater scope for contributions coming in. And so the timing of our pension commencement requests versus when those contributions are coming in, to ensure certain contributions don't potentially get mixed up in other accumulation interests, so that we get the timing of that pension commencement right. And by extension of that, then the request to undertake partial commutations or lump sum withdrawals. whilst we don't have, or whilst 2017, pre-2017, we had a legislative requirement to make an election to do the lump sum withdrawals from a pension account. Now it's not a legislative requirement, but it's a reporting requirement, because we need to report transfer balance account transactions. And so from a transfer balance account point of view, we want to make sure that any partial commutation is reported in a timely manner, because then that's going to have an impact on if we're putting contributions in and then recommencing new pensions, but also if we're doing full commutations and then rolling money out of the self-managed super fund, that we're meeting our obligations there. So making lump sum withdrawal requests and partial commutation requests are as critical from a timing point of view, and are both sort of proactive strategies that we need to be mindful of, because they are linked to potentially that transfer balance account reporting requirement. Now, what we would have all heard for recent sort of days and weeks, and it's been ongoing for a while, but we've got greater confirmation over the last couple of weeks from the tax office, is that the transfer balance account reporting regime will be changing from the 1st of July 2023. And so all self-managed super funds will move to a quarterly reporting requirement. Now, we might look at that and go, okay, well, that puts the onus on timely transaction processing and trustees and members being more aware of what they're doing and undertaking, so they can report back to us. But it also assists in removing the anomalies of a self-managed super fund not reporting for, say, 12 months, but money's being moved in and out of, say, industry or retail funds, potentially creating excess transfer balance account credit. So we're actually reporting in a far more frequent basis, and that's going to reduce the impact or the potential impact of excess transfer balance account transactions occurring. So again, all these sorts of things are linked, but form part of the overall future planning part of the self-managed super fund, which inevitably results in a smoother audit fund, or a smoother audit of the fund each year. So hence why it's one of those key issues. Now, when I started working through the audit part of this presentation, clearly the number one issue that jumped up for me was valuations. Now, as I said, valuations in itself is a fairly significant subject matter, and so I can't do it complete justice in the time frame today. But I just urge everybody to review the valuation guidelines for self-managed super funds that the ATO provide, and you can use that. You can enter that quick code 26343 on the ATO website, and that'll provide that documentation. But it does a couple of things, and what that document provides is the ATO's position with regards to how self-managed super funds need to value their assets and when self-managed super funds should value the assets. And it ties in nicely then with the auditors' requirements. And you got an understanding, obviously, that the auditors are also they have their own audit guidelines that they're required to follow. And so they need to be able to substantiate the valuations. And then if we reflect back to the whole life cycle issue or piece that I've been sort of referencing, we want to make sure that from our pension commencement that we're reflecting the true value of the fund from our annual reports and our member statements. We're under an obligation to value the assets at market valuations. So, it's really key that we understand the issues associated with valuations. And when we get the question, and inevitably we get it every year, it's like it's too hard to get a valuation on specific types of investments. Then the question actually has to be asked, well, then is that investment appropriate for the self-managed superannuation fund? Now, I can throw that sort of statement out there because from a sole purpose test point of view, if it's too hard to value, is it going to be too hard to liquidate? What are the issues associated with that investment that are going to make it problematic in the future for the fund, which is ultimately a consideration when the fund enters into that investment in the first place? Why did they undertake that investment inside their self-managed superannuation fund? Was it for the sole purpose of providing retirement benefits to the members of the fund, or was there some other purpose, be it cash flow or some other reason? And again, I generally like to bring a little bit of my own personality and life into these examples, and from a valuation point of view, and from a sole purpose test point of view, I recently invested in some sort of startup, and they're not actually startup, but some craft beer businesses who are looking to expand their operations. And when going through the investment process, and don't worry, they're not in my self-managed superannuation fund, but in going through the process of undertaking those investments, I understood exactly what I was getting out of the investment, and largely that was a discount on the acquisition of beverages. But what I also understood was, if I entered into those transactions knowing that I'm getting a 10% discount or whatever it might have been, then from a sole purpose test point of view, that's not insignificant to the decision that I'm making. Now, the flip side of that is that all of these investment opportunities quite clearly stated that you can undertake these investments in your self-managed superannuation fund. Now, thankfully, I understand a little bit about self-managed super funds, so I knew that that wasn't the appropriate transaction. But what about other trustees? What about others that have an interest in A, self-managed super funds, and B, craft beer? Would they look at that transaction and say, it's worthwhile for my superannuation fund? Now, why am I raising this under valuations? Well, having made the investment, I subsequently got a communication back to say, thank you for your investment in, XYZ beer or brewery, whatever it might have been. Please understand that these shares are not that these are investment in a private company as such. They're not listed anywhere, so there won't be ongoing or regular valuations. It won't be easy to, or you won't be able to sell the investment. You are effectively becoming a part owner in the company. Now, to say to somebody that they can't actually sell the shares, there would obviously be a way, but the further you look into the transaction, the more difficult it would be to have in a self-managed superannuation fund, and the more difficult it would be to obtain a valuation once we move outside the initial share offer process where you have a fixed price for the investment. So all of these sorts of things, I think, are quite important and relative to the audit process, and understanding that we all get a little bit of angst when the when the auditor comes back and says, we want to get a more appropriate valuation, or at least a further valuation done, and it has more information, comparable sales or whatever it might be, and we get a little bit frustrated. Well, that's not really the auditor saying that to us. I mean, yes, it is, but it's actually coming back from a regulatory point of view to what the ATO expects. And over the last couple of years, the ATO have gone harder on their guidelines about what is required to value assets. So it's got to be based on objective and supportable data. But the biggest one, probably the biggest movement over the last 2 years, has been this concept of the provision of comparable sales. And so therefore it almost is, I guess, to put it bluntly, the death of the drive-by valuation, where we go and just obtain a real estate valuation that says, based on comparable sales, we think this property is worth X. Well, you can say that, but now you have to show why, and you need to be able to provide a list of those comparable sales. Now, again, bringing that back to a personal point of view, late last year, I sold my house, and I was identifying which agent I wanted to use to sell the house, and the first couple that came in just printed off a list of comparable sales in my area. And so, that would probably be appropriate for the SMSF point of view. But then the agent that I chose, they actually provided comparable sales across a whole heap of other suburbs in the state, and sort of like-sized properties, just to be a far more comprehensive document, or I guess way of showing why they thought we could get X amount for the sale of the house. And so when we try to entertain these valuation issues and people are saying, well, it's too difficult to obtain that information, that's not acceptable, because it's not too difficult, it's just too inconvenient. And so we need to say, okay, well, part of investing in property means that you're going to have to provide better valuation documentation, or supporting documentation from a fund administration point of view, but also from an audit point of view as well. So all of those sorts of things are fairly relevant. That then takes us on to the investment strategy. So when we're talking about valuation, that forms part of the the overall investment strategy. And of course, the requirement to value the assets from a SIS regulation point of view was introduced at the same point of the SIS regulations to regularly review the fund's investment strategy. And what we know is that investment strategies have become a far greater focus of SMSF auditors. And, I'm the first person to admit that for probably the first 15 years of my time in the SMSF industry, I said SMSF investment strategies aren't worth the piece of paper they're written on, because they were fairly meaningless. They didn't actually say too much about them. They basically just regurgitated what the legislation said. Now, the upshot of that is that most auditors that I now communicate with and speak with in doing training and education along the way are saying they're not just going to accept an investment strategy that repeats the trustee covenants straight out of the legislation. They want to actually see some form of meaning in what people are doing, and what are the objectives of the fund? How does the fund expect to achieve that? Now, a vast majority of us are now providing that, as a result of the ATO taking a far closer look at fund investment strategies to ensure that that funds are at least meeting their strategic objectives. Now, of course, the other part of that is that they're not telling you what you can and can't invest in. So they're not changing the way we think from an investment point of view. They're just changing the way we document that process. And I think that there's a lot of value and accountability in actually doing that from a documentation point of view. So it's a key issue for the fund. And so the regulation, as I said, the regulation that was brought in at the same time as the valuation requirements for super, also introduced the view, the fund's investment strategy, and no real greater time than the last sort of 3 years. And I've highlighted the COVID stuff already, and we'll revisit that in a moment. But not only COVID, we've now got inflation considerations. On top of that, we've got rising interest rates considerations. And so, how does that impact the fund investments? And, where we've had previously term deposits and cash accounts basically paying 0% interest, we're now starting to see that there is some accounts out there that are increasing the interest that they are paying on term deposits, etc. So, it's now one of those situations where we should be reviewing the fund's investment strategy to make sure it is meeting our ongoing obligations. And of course, the other part of our legislative requirement that was introduced at that same time was the need to consider insurance. And so when we flip this all around and say, okay, well, what's insurance got to do from an audit point of view? And largely, it to me, other than making sure that there's a separation of assets so that the insurance is appropriately titled in the name of the trustee of the fund, there is a key issue that the insurance is an insurance policy that can be held inside the superannuation fund. So ultimately, our death cover, our any occupation, and our income protection. But then, by playing devil's advocate, is the income protection appropriate inside the self-managed super fund? Now, we know that the tax office have addressed this a number of times over probably the last 20 years and said that, if you can show that it is appropriate for the superannuation fund and then there is an income protection payment out of there, then no issue. And a lot of that was linked to deductibility. But the whole reason things like trauma insurance and that were effectively outlawed from self-managed superannuation funds, or from superannuation as we know it for the small funds, was that it didn't necessarily satisfy any sole purpose test requirement. It didn't necessarily satisfy any condition of release, and so it was one of those things that got removed. So insurance is far more prominent now than it ever has been, and for one reason primarily is that it's deductible inside the superannuation fund. But then the idea of holding insurance inside the fund really becomes relevant as to where you hold that insurance inside the fund, which interest. And again, I revert to the strategic thought process of age 65 to 75. And if you're going to have pension and accumulation interest inside the fund, one part says, well, if you're putting the insurance premium is not subject to the ECPI, so you'll still get that deduction for the fund. But where the insurance proceeds hit the fund in the event that something happens to the member, do you want that sitting in an accumulation interest? Do you want that sitting in a reversionary pension? Or is it going to sit inside a pension that has discretion attached to it? Because if it's inside a reversionary pension, then it has no transfer balance account ramifications for the reversionary pensioner. Whereas if it's sitting in accumulation, or if it's sitting in a non-reversionary pension, then it's going to impact the credit to the transfer balance account for the other member. Now, again, what most of us would appreciate is that most people won't have insurance inside their super fund at that point in time that they pass away, if they pass away post age 80 or whatever. But that's not everybody. And so we need to ensure that those that want to maintain insurance are at least contemplating where it's being held, right, and where the premiums are coming from, and what the ramifications are of where it's being held. And one of those ramifications can be the untaxed element. And so again, when we're talking about not so much the audit side from an untaxed element point of view, but when we're talking about the future proofing, having insurance inside a fund where the ultimate beneficiaries are going to be non-tax dependents, if you've got that insurance sitting in there, then part of the advice piece, part of the tax and accounting piece, is to at least future prepare people for the ramifications or potential ramifications of holding that insurance policy. And that ramification is that, the further out someone to age 65, the greater proportion of that benefit is going to be potentially an untaxed element and result in an additional 15% tax. Now, for the large proportion of funds with insurance proceeds, the benefits are going to be paid to a spouse. They're also going to be paid post age 65, but we don't know when members are going to pass away. And so those that have insurance and pass away pre-65, untaxed element is a real consideration, and we need to prepare the parties for it. So again, the whole concept of annually reviewing fund issues for the annual audit that needs to be undertaken is always a good time to also review the future element associated with any transaction in the fund. And that future element might be whether the insurance is appropriate in the fund. And then if we decide that the insurance isn't appropriate in the fund, then going back a step and saying, okay, well, now we need to adjust our investment strategy and reflect that the insurance has been removed in the investment strategy and document the reasons why. So all of these things, as I said right up front, are implicitly linked, and we need to make sure that we're covering off on all the key issues. So very quickly talking about COVID-19, hopefully for one of the last times. Obviously, we've had to present on this sort of stuff a little bit too much over the last few years, but what we know is that we do have an in-house asset exclusion, again, from the ATO that applies right up to 30 June 2022 if we needed to have a deferral of rent, basically. So if we've got the deferral of rent because of COVID-related income deficiencies, and therefore we provided that deferral versus a waiver, then it's going to provide or produce effectively a financial statements, a ledger account for that deferred rent. Now, that deferred rent, if it's a related party, is effectively financial assistance. So that financial assistance would be recorded as a loan and normally would be considered to be an in-house asset. What this determination provides for, and the determination that's been in place over the last couple of years, is that asset won't be an in-house asset now nor in the future. But what it ultimately means is that we've got this situation that we have to continually monitor until that deferred rent is paid off. So the nature of the deferred rent was often an extension to the lease, and that extension to the lease will expire at a certain point in time. And we need to make sure that those rental payments have been caught up in that time frame, because at some point, if that liability still sits inside the superannuation fund and the rent or the lease has expired, then we're probably going to have an in-house asset, because I wouldn't think that the ATO would look too favourably on that. So we're under effectively for those funds with property investments leased to related parties, we're sort of under a heightened sense of urgency to continually monitor the capacity for the fund to collect its outstanding rent, not just the current years, but any backlog of rent associated with it. Similarly, on the other side of the coin with loans, so limited recourse borrowing arrangements to related parties, primarily, where if we haven't been making those repayments because of the COVID situation, that the term doesn't get any longer. So if we've got the 15-year term under the PCG, it means that we've got a restricted time frame, and now even less so, given that we're now 3 financial years later than when COVID started. We've got less time to make those repayments on the loan, and so there is a greater requirement from a liquidity point of view to be able to fund it. And what we don't want is to be in a default situation there. So all of these things sort of play into our mind, and often, and the reason why I want to raise it is, how many of us have not necessarily forgotten, but moved beyond, say, the CGT relief that was provided when we moved into the transfer balance cap environment. We all made a big song and dance about that back in 2017, and we may have had a deferral of capital gains tax. Who's kind of forgotten about that with their funds that had that deferred capital gains tax? Has the reporting been done appropriately? And I relay that now forward to the COVID-19 relief measures to make sure that people are doing the right thing. And of course, the expectation is that there will be no further relief. But of course, intriguingly, we got the 50% pension reduction. So, there's speculation. A lot of people speculate that, that 50% reduction is something to do with a broader or bigger picture about retirement income reviews and things. But of course, that announcement was made under a previous government. So we need to wait and see where the current government sits with regards to their superannuation policy. And then once we get a little bit further into their government, we'll sort of work out where we're moving in the pension environment. But again, if I actually jump back to the investment strategy concept for a moment, and something that doesn't apply to self-managed super funds, but all other superannuation funds had to implement their retirement income covenant from the 1st of July this year. Now, self-managed super funds were excluded from that because it was largely felt that already via our fund investment strategies that we're contemplating, the retirement income needs of the client, but a lot of people wouldn't necessarily be formally documenting that beyond the existing scope of their fund investment strategy. But just because something doesn't exist in the SMSF space doesn't mean we shouldn't be using it as a tool to determine what is the most appropriate path forward for the existing members and future beneficiaries of the fund. And part of that is the retirement income planning. Do we have the appropriate strategy in place to provide the ultimate benefit, or the benefit that the clients and members ultimately want once they hit that retirement stage? Probably the one issue that has been almost, if not more frustrating than the COVID issue, is the non-arm's length expenditure issue. And we did get a recent update to the practical compliance guidelines, which said the ATO will be extending their compliance approach to the end of 30 June 2023, which means that those expenses of a general nature that have a link to a nexus to all of the income of the fund, so accounting, administration, those sorts of fees, they won't be taking compliance action against those transactions over the next 12 months because the government has largely committed to a review of the existing NALI rules to determine if it's actually fit for purpose and meeting its obligations. Now, most of us will say that it's not. The purpose that they came in for, which was largely linked to limited recourse borrowing arrangements and the interest rate associated with them, by expansion, it's gone a lot further. So when we're entertaining non-standard transactions, and a lot of those transactions inside a super fund will be linked to property transactions and other things, we need to be mindful that whilst this nexus is linked to general expenses, there will often be other non-standard events and transactions that occur in a fund that are linked to a specific fund investment, such as property, and we need to make sure that those transactions are dealt with and operate under arm's length requirements. So again, making sure we're doing the right thing for all investment transactions for all existing investments that that the fund currently has, to make sure that we don't create a future tax problem for the fund. But I think most of us, if not all of us in the industry, want to see this non-arm's length expenditure stuff put to bed so that we have absolute certainty on it. I'm not sure that we'll ever get absolute certainty, because even if we remove all the general nexus stuff, there is still this sort of debate of individual capacity versus trustee capacity and what you can and can't charge for in that regard. And I think that that's quite still a grey area that we need to be mindful of. So anyhow, I wanted to raise that as one of the key issues that I saw as it's not so much an audit issue, but it's certainly a future proofing thing to make sure that all of our transactions are undertaken on an arm's length capacity. And then the ECPI and segregation. And again, this is kind of it's not linked to audit in the sense that yes, the auditors will review the numbers of the fund and the taxation side of things are part of probably the overall review, but the ECPI element of it is not specifically for the auditors to be mindful of as much as it is for the trustees and those that are doing the administration and lodging the tax return, to make sure that we get our actuarial and ECPI requirements right. And so what we did get for the 21-22 year was some relief from some of the 2017 changes, particularly or firstly around disregarded small fund assets. So we had the stupid legislation before, and that's pretty much the only way that it could be worded, piece of legislation where if you had disregarded small fund assets, but 100% of the fund was still in pension, it meant you couldn't segregate, but you had to get an actuarial certificate to tell you that 100% of the income was exempt income. Now that has been removed. So if you've got disregarded small fund assets and you've got a fund that's only paying a pension, then that fund doesn't need to get the actuarial certificate. So that's a positive measure there. The extension of that was the other requirement that came into place, where previously if you moved during the year, so if you had a fund that had a part of the year in accumulation and a part of the year fully in pension, then previously you had to treat the pension period as segregated, and the other period you could nominate for that to be segregated, but you generally had to treat that as unsegregated, and you needed to get an actuarial certificate for that period, which made the process, because you could only ever get a single actuarial certificate for the year, it made it quite complex when you had multiple periods through the year. Now trustees have got a choice, and it's not a formal choice in the sense you don't need to report it to the tax office, but it's certainly something from an administrative point of view that it's a good conversation to be having, where if the fund is not 100% in pension for the full year, you can choose to apply the segregated approach, or you can choose to apply the proportionate approach. And when we think about this from a practical point of view, a lot of the conversations that I have with people about this choice is about capital gains versus capital losses, right? So we appreciate that if you have the unsegregated approach, so the pooled investments, that you can carry forward your capital losses. Now, historically, that probably was less relevant, because if you were moving 100% into pension at some point in time and staying there, then those capital losses that you were carrying forward were somewhat irrelevant, because when the member passed away, the ECPI would continue on until the death benefit was paid. So you'd be able to sell down those assets without the CGT implication. Of course, now going back to the 65 to 75 contribution strategy opportunities, is that we're more likely to have members with pension and accumulation interests. And so, there will be this ongoing potential or partial tax liability inside the fund. So there is a greater desire to be able to maintain any capital losses. You can't maintain capital losses if they are sold from a segregated pool of investments. So if you've got a fund that hasn't been in pension for the whole year but does move there, then it may be worthwhile to make the choice to use the proportionate approach rather than the segregated approach. But it's always going to be a case-by-case scenario. But the good thing is we've now got the choice to be able to do one or the other. And I think that's a fairly important area or thing to have. And again, we're obviously talking now, I've tried to make this a little bit cyclical with regards to transactions associated with where we are sitting in the superannuation life cycle. It's not completely like that because of the changes to the work test, which mean our contribution strategies and the timing of contributions has effectively moved. But from the 1st of July this year, with the removal of the work test pre-age 75, or not the removal of it, but the movement of it to the Tax Act versus the SIS Act, it basically means that we can make contributions up to 75, which is quite positive for our non-concessional contributions, which are then only subject to the total superannuation balance as to what our non-concessional contribution cap is. So that makes a huge benefit for it. But it is an audit issue for 21-22, because anyone that is over the age of 67 in the 21-22 year and has made a contribution, then they are subject to that work test or the work test exemption, so the $300,000 at the previous 30 June, but they're subject to the work test. So as we enter the 2021-22 audit program, we need to make sure that we're meeting or have at least got the supporting documentation, supporting material to show that the trustees are satisfied that the member met their gainful employment requirements to be able to make those contributions. So we're in that awkward introductory timeframe where strategically moving forward, the removal of the work test is great as we're planning the future-proof part of the fund. But from an audit-proof part of the fund, any transactions that occurred last year, we can't be too flippant about. We need to make sure we're supporting and providing that supporting documentation. And of course, it does have a flow-on effect to the personal deductible contributions and the new rules in the 22-23 year, is that you still want to be maintaining your capacity to keep your supporting documentation for being able to claim personal deductible contributions and meeting the work test, because if you're trying to claim a personal tax deduction in the 22-23 year onwards, then you'll need to be able to justify that to the tax office from a personal tax point of view, not from a super fund point of view. But the real sort of issue that I see, and I've raised this a number of times in various presentations, that this work test change brings about, is that now that the age has reached 75 for being able to make non-concessional contributions, it basically means that our capacity to make mistakes in the SMSF environment largely disappear, and all personal contributions that are made to a fund prior to age 75, well, the trustees are under no obligation necessarily to reject those contributions. So once it's received, then it's subject to total superannuation balance, and it may be that the person has more than $1.7 million in total super and therefore wasn't eligible to make a non-concessional contribution, and it's going to result in an excess contribution. Whereas pre-1 July, under the old rules, if you didn't meet the work test post age 67, the trustees couldn't accept that contribution and it had to be returned. So again, it's just that education piece that we're providing to those trustees in that age bracket 67 to 75, that there's got to be absolute certainty that they're entitled to make the contribution, because if from a dollars point of view, so from a total super balance point of view, because if they make the contribution and there was no entitlement to it because the cap was zero, then it will be in excess and there won't be the capacity to refund it. So all of those sorts of things, I think, are fairly critical in understanding as we move beyond 1 July 2022. And so just to tidy out that contribution piece around the whole personal deductible contributions, obviously they can be utilised to offset any income pre-age 67. So, whether we've got various trust distributions or other sorts of investment income that we're trying to offset, then up to age 67, there's not going to be any work test obligation. Now, what that actually means is that we really do need to have an understanding, and of course it's a client's obligation, or it's a member's obligation from a personal tax point of view. They need to have an appreciation of their birthday, because any contribution made up to their birthday would be deductible under the new rules, but any contribution made from their 67th birthday up to their 75th birthday would be subject to them meeting the work test or the work test exemption if they wish to claim that personal tax deduction. So, it's not really a change in the sense that previously you couldn't make personal deductible contributions over the age of 67 anyhow, if you didn't meet the work test. Now it's just codified in the Tax Act, and so we just need to be mindful. But there's no acceptance requirements from the super fund point of view. So we must meet that work test exemption to be entitled. But where there is this issue is the notice requirements and making personal deductible contributions. If we assume somebody is continuing to work through that period right up to age 75, is that we've got a requirement to provide a notice of intention to claim a tax deduction. But if we're commencing pensions, if we're taking lump sums out of our super benefits, then both pensions and lump sums have a calculation point where we calculate the tax-free and the taxable portion of the fund immediately prior to the pension commencing or the lump sum being taken. Now, definitively, when you start a pension, right, if you haven't lodged a notice of intention to claim a tax deduction at that point in time, 100% of the benefits are going to be non-concessional contributions. So you don't have the capacity to lodge a notice after that point. So you need to, as part of the pension commencement process, incorporate the review of any contributions to ensure any notice of intention is lodged. With lump sums, it's a little bit different in that basically if you take a lump sum that's not a full lump sum of the entire balance, then any notice of intention will be reduced proportionately based on how much tax-free benefit is included in that lump sum. So it really just changes the way we need to think about the timing of our notice of intention to claim in the environment between 65 and 75 when we're drawing lump sums and pensions, and particularly if we're drawing lump sums from the accumulation interest, which won't impact our transfer balance account point of view, but they might impact our deductibility point of view if we're then also subsequently commencing pensions or wanting to claim a personal tax deduction. So all of these things are linked to each other, as I've highlighted a couple of times already. And so that's really just a flow on to, I guess, the overall strategy piece associated with the future proofing and the future planning for the funds, which is where do we take lump sums, where do we take our pension benefits from? Because now we've got this great strategic opportunity from a contribution point of view right up until age 75. But then if we're also going to offset the contributions by either using recontribution strategies or just topping amounts up by getting access to other monies via potentially estate payments and other things, then how does it all work? Where are we going to take the money down? What's the impact it's going to have on the transfer balance account? What's the impact it's going to have on the ECPI of the fund as to where we take it from? What impact is it going to have from an estate planning point of view? And are we applying these strategies prospectively? So are we actually saying to our clients that if you're going to take lump sums or lump sums versus pensions, that the implication is a benefit is a pension payment unless you make an election or make a statement prior to that point in time that the benefit is going to be a lump sum withdrawal. So it's all relative, which of course, because that segue to the estate planning, it then leads us to the final piece, which for me is the future proofing the fund versus the audit element, and that is the nomination of beneficiaries. And so as critical as it is to review our fund investment strategy, and I would say, on an ongoing basis, so not even sort of limiting that to an annual basis, the capacity to review your nomination of beneficiaries, it becomes a little bit clouded because of this recent very positive High Court case, Hill versus Zuda, because what Hill versus Zuda Proprietary Limited provided us with was certainty that our self-managed super fund trust deeds override the SIS regulation requirements about binding death benefit nominations. So it gives us that capacity to have non-lapsing binding death benefit nominations. But of course, with non-lapsing binding death benefit nominations comes the risk that they're non-lapsing, and circumstances may have changed and you may not want to nominate a particular person, but the law still dictates that they're assist dependent, and of course it's non-lapsing, so you haven't reviewed it, and then someone passes away unexpectedly, and the person who you didn't want to receive the benefits is subsequently receiving the benefits. And so future proofing to me suggests that whilst it's great to have certainty around binding death benefit nominations, we still need to be reviewing our deed and regularly reviewing our nominations. One, to make sure we can have non-lapsing, because a deed is silent, as in silent on the SIS regs, but is prescriptive as to how nominations should be set out, but then that our nominations mirror what our deeds provide for, so that we're regularly reviewing them. So even if they are non-lapsing, we are reviewing them on a regular basis. But I think the result of Hill versus Zuda is a far more positive one than had the result gone the other way, where we would have had to review all of the non-lapsing nominations and turn them into 3-year nominations. At least now, as 3-year nominations lapse, the conversation you can have with your clients is, what do you want to do? Do you want to put in place another 3-year one, or put restrictive times on it, or do you just want to go to non-lapsing? But either way, make sure you continue to review it. So, as I said, that was a real quick fire overview of a lot of the issues that I would see from a pension, from a pension point of view, from a planning point of view for the fund in prepping for audit, but also in future proofing as much as you possibly can to make sure all of your documents actually meet what your requirements are. So it's a good time of year to do that overall review of your fund to get to that point. So if anyone's got any questions, please put them in the question box. But otherwise, my next webinar will be on the 11th of August. And in that webinar, I'll be doing a bit of an overview of property investments in a self-managed superannuation fund, because again, a lot of these issues, whether it be around the audit issues, around non-arm's length expenses, around even the in-house asset requirements and investing via 1322C trusts and things like that, a lot of them are linked to property investments. So it is a very significant part of our industry. So I look forward to you all joining me on the 11th. No questions, so thank you very much for attending today, and you'll receive a copy of the PowerPoint with the CPD that will come out hopefully later this week.